Welcome to Bank On It, Conversations with First Seacoast Bank. Today's topic, Demystifying Credit. I'm your host, Chris Hislop, and here with me today is Stephanie Morneau, VP, Retail Loan Production Officer at First Seacoast Bank. Stephanie, welcome to the program.
Thank you.
How are you doing?
Good. It's hot out there today.
It sure is.
My car said 93 degrees.
That's not cool. Stephanie, how long have you been at First Seacoast Bank for?
7 years.
7 years? And did you start in the role that you're in now, or did you move up?
Nope, I started in the role that I am now, VP. I had prior experience at other banks since 2000, so about 25 years. I've always liked community banks. I've always been mostly at community banks. I did go to a couple of larger banks in my career, and very different mentality. So I just appreciate the community feel.
So today we are focusing on preparing for home ownership. So wanted to start with you talking about credit. Why is that important?
I think credit, unfortunately, I don't think the kids in high school and college get prepared for credit. They may learn about checking accounts and savings and things like that, but credit is one of those things that it's almost your reputation. Even just renting a place versus purchasing a home, they're going to pull your credit, see what kind of payments you make. Are you always on time? Now they do what's called trended credit, where they look to see how much are you paying on your credit cards every month. Are you just paying the minimum, or are you one of those people that is trying to pay down that balance? Are you trying to pay a little extra on it? So I think credit is an important piece of buying a home that people don't think about. They try to save enough money to purchase a home, but you can have 20% to buy a home, but if you have a 500 credit score, you're not going to get anywhere with any lender.
Are there tips that you offer to customers that speak with you around, getting in a better position from a credit perspective?
Yeah, for sure. Your credit balances on your credit cards, you want to try and keep those below 50% of your max spending limit. So if your limit is $1,000, you never want to go above $500. That's your utilization rate on your revolving credit. So if you can keep that below 50%, it's going to greatly increase your credit score. Lenders, when they say they're looking at recent history, they don't want to see any recent lates. They're looking at mostly the last 2 years. So if you have excellent credit, you have a really good credit score, and 6 months ago you have a 30-day late on your auto loan, you could be denied, and some lenders will deny you. The good thing about a community bank and a small lender is we're going to say, okay, we're going to look at the whole picture. You have really good credit. You have a really good credit score. What happened here? What happened 6 months ago that you were late on your auto loan? And there could be a very good reason for it. And if there is, we may decide to move forward. But that 24-month history is very, very important. So along with all history, if you had a bankruptcy, a charge off, we want to see clean history, but that 24 months is really important.
And when you're looking at, you were talking about with credit cards specifically in not exceeding that 50% threshold, are you looking at the history there? Like if someone comes into the bank today and they're below that threshold, are you looking at that 24-month history and saying, well, you're at 90% for 11 of these 24 months, 75%, you know what I mean? Like, are you looking at that piece specifically over that 24-month period?
Yeah, well, I think that's been the nice part of where the industry has moved. A lot of lenders were just looking at credit score and approving based on credit score. Secondary market like Freddie Mac and Fannie Mae have now required this trended credit view, and they want you to look at that 24-month history, and that's the reason. They want, just because 1 month they're over that 50% utilization rate, there could be 11 months prior to that they weren't, right? Mm-hmm. So we want to give people that fair opportunity to get a loan and not just say, oh, your credit score is down this month because your balances are high. Well, what did they look like, in the last 12 months? Is this a habit for you?
We're taking a quick pause to bring you what's in your wallet. All right, Stephanie, we're going to move into a segment we like to call What's in Your Wallet, in parentheses, or app. What do you have in your wallet that might be interesting to somebody listening in?
Well, it's funny because in this digital era that we live in, I still have a pen in my wallet. I always carry a pen with me. You really just never know when you're going to need a pen.
I carry a pen too, all the time. And people think I'm crazy.
Yeah.
What do you use it for?
Sometimes I have to write a random check. You feel like who writes checks these days? But honestly, you sometimes have to, especially if your kids need something, at school or whatnot. I don't know, or just the need comes up sometimes.
It's a mighty tool.
Yeah.
I love it. So what if I'm a person that has never looked at my credit report before, doesn't know where to begin, doesn't know where to look? How would I even know where to start?
Yeah, so get past the score. The score is an important piece, but you want to look below the score at your trade lines. Trade lines are each account, right? So let's just say your Capital One credit card, that's one trade line. Your auto loan, that's a second trade line. Many lenders want to see at least 3 trade lines with a 12-month history. So when your younger kids, young adults are getting ready to want to buy a house one day, have them open a credit card, maybe a small balance, and get them establishing that 12-month payment history. The other thing is it used to be, I don't know if you used to hear all this talk about at least pay the minimum on your credit card, right? At least pay the minimum so you don't have any lates. But the issue with that is you could be at your max limit. Sure, you're paying the minimum so that you don't have any lates, but that max credit is hurting your score every month because you're not paying that down. So look at your credit cards and say, what's my balance? And can I put a little bit more each month on these to start bringing them down? Auto loans, secured loans like auto loans and things like that, those don't hit your credit score as much as like an unsecured debt. So just make sure you're paying those on time. There's no need to pay extra if you can't on the installment, like auto loans and things like that are secured. But I have 2 younger kids. They just rented an apartment and they have excellent credit scores, but they call their credit report a ghost report because while they have an excellent credit score because they have a small credit card that they've been paying, they have 1 trade line each, right? So I had to co-sign on the apartment because, yeah, your credit looks great, but when you really dig into it and look at the trade lines, it's like, yeah, you have a 720 credit score, which is awesome at your age, but you have 1 trade line that you've been paying 6 months on. That's not going to help them. So, another good avenue is you get a secured loan. So if you have $500 cash or your parents, you take out a loan for $500. The bank holds that $500 as collateral while the child, the person, whoever, this is a good rebuilding credit tool as well, pays on that loan every month, and we report that to the credit bureau. So it looks like a loan that they're paying every month, a secured loan, but the bank's risk is lowered because we're holding that cash, which we will give back to them at the end after the loan is paid. So that's a great tool to rebuild your credit.
In terms of seeing the credit report itself, how would somebody that's never looked at it before even figure out where it is?
Yeah, it's super overwhelming. There's a lot of ones, 11111, or a lot of codes, and they're very confusing to look at. What you want to look for is the name of the creditor, because then you could probably piece together what that ties into. Like, okay, this is my Home Depot credit card, and then you want to look at the type of credit. So it'll say auto, revolving, mortgage. So then you know what type of credit it is. And then over to the right, there's going to be a history box, and it's going to tell you how many 30 days past due, how many 60 days past due, how many 90 days past due you've had for the life of that credit. And then there'll be these ones. like I was talking about that 24-month history. All ones is a clean history. If you have 111 and then there's a 2 in there, that's a 30-day past due. And those go by months. So you kind of have to count January, February, March, April. So it can be tedious and it's difficult to look at, but identify the account, identify the type of account, and look at your 30, 60, 90 past dues and your balance compared to your limit.
Are there other things to keep in mind in trying to keep your credit in good standing?
Just don't rely on debt, right? Don't open too many unsecured accounts. You see patterns. We see a lot of credit reports, right? And you can tell the people that rely on unsecured debt just to live every day, and they'll just keep opening accounts and spending that unsecured debt, but then you can see it never gets paid down because they're at their max. So try to live below your means is a great way to establish credit, and try to focus on secured accounts. Build your credit with secured accounts.
What's the difference between unsecured and secured debts?
Secured debt is it's secured by a car. It's secured by like that cash I was just telling you about. Unsecured is like a credit card. There's nothing securing that. If a lender has to come after you, there's not a car that they can take and sell and get their money back. There's not cash in an account that they can recoup their losses. So unsecured is very risky for lenders.
Makes sense. And once someone has stabilized that credit score, they've got a good thing going, feeling comfortable, what's the next step that they would take in order to get a home mortgage? Sort of circling back on the home mortgage piece here.
Yeah, I think that's important because there's so many lenders out there, right? And there's mortgage companies, there's banks. How do they know, the difference between those kind of lenders? A mortgage company typically is going to sell you a loan. They don't have a portfolio, right? Banks have their own money. They have a portfolio. They can keep your loan. Mortgage lenders have to sell that loan to recoup that money to then keep on lending. So I guess, a lot of times that's important to people who like community lending. They like their loan to be with the bank. They like to be able to come in and talk to someone. They don't want to call whoever it was sold to and not know how to get in contact with a person if they have a question. And sometimes that's not important to people. There's a lot of people out there that are just rate driven and they want the best rate and they don't care if they can't talk to somebody. That's not typically what we see with our clientele, but that's something to consider when you're a first time buyer. Is you typically need a lot of guidance. So I would stick with like a local lender that can really provide you those tools and that education. The other thing is I would try to move away from the fear of PMI, private mortgage insurance, and be okay with putting 3% down on a house or 5% down on a house and keeping some extra money in the bank for things that could go wrong. Maybe your furnace is dying, or maybe your roof is coming due. And if you put all this money into your house on the down payment, you're going to have no money for reserves for the ongoing maintenance of the home.
That makes sense. Can you unpack a little bit about what private mortgage insurance means for someone that might not be familiar with the term?
Yeah, let me give you an example. So I just recently purchased a house, and I decided to put 5% down instead of 20% to keep some money in the bank because there's things I wanted to do to the house. And that private mortgage insurance is only costing me $100 a month. So for $100 a month, I'm able to keep $50,000 to $100,000 in the bank, right? Seems like a no-brainer. Mm-hmm. And what that private mortgage insurance does is it protects the bank. So because the loan to value, meaning what the home is worth and what I paid for it, are closer together, because I put less money down, there's more risk for the bank. This private mortgage insurance company will say, okay, if this borrower defaults, we're going to step in and give you some of that money to bring you down to that 80% or that 20% down payment, that 80% loan to value, right? So because you're not putting 20% down, that private mortgage insurance will say, lender will give you that additional money if they default, and then you go and sell the house, and hopefully you can get 80% of the value.
It seems like a great tool for a first-time home buyer to take advantage of.
There's nothing negative around it. There's no negative reporting on your credit report. There's no, realtors aren't negative about it. They're very familiar with PMI. Sometimes there can be some negativity around FHA and VA loans because the appraisals are a little bit stricter. They're very picky. There can't be any deferred maintenance with the home. So sometimes realtors would be like, oh, it's a VA or FHA loan. That is not the case with PMI. PMI is very common. A lot of people have it. And yeah, it's a great tool.
Yeah, it seems like a pretty safe route to take too.
Yep.
So how long do you need to carry that PMI for? Is there ever an opportunity to get rid of it along the way?
Yes. So I will say, of all the people that get PMI on their mortgages, I have never seen someone carry it to the full term. So a lot of times the full term could be as long as 10 years, right? I've never seen that happen. And the reason being is because homes typically appreciate in value. And so after you've had a 2-year clean payment history on your mortgage, you can go back to the lender and say, you know what, I'd like a new appraisal. I think the value of my home has increased and I may be able to drop my PMI. The lender orders the appraisal, the borrower pays for it. And as long as that value comes in high enough to give us that 20% equity, so 80% loan to value, we drop the MI. There's no fee. I mean, it's as simple as that. We cancel it, and your next payment, you have no PMI for the rest of the loan. That happens many, many times. That's a common practice, especially over the last few years with values really increasing.
That makes sense. Now, Stephanie, what's your day-to-day look like at First Seacoast Bank, and where does your work fall in line with the mortgage acquisition process?
So I oversee pretty much the entire front end process. So from underwriting to processing, closing, selling the loan if we decide we're going to sell it to Freddie or Fannie. And let me just say there that when we do sell a loan to Freddie Mac, we keep the servicing. So again, we may be selling your loan, but you will always deal with First Seacoast Bank. That's an important piece to us. That's an important piece for our community banking and the relationships we have with our borrowers. We want you to always be able to come to us. So I oversee all of those pieces, the appraisal, the underwriting of the appraisal. And I will say one of the things that I like about community banks is that we look at every single loan. We don't have a checklist that says, oh, your credit score is below 680, move it on to denial. Or, you had a 30-day late, within 12 months, move it on to denial. We look at the entire picture. We say, what do their reserves look like? How much money do they have in the bank? What's their credit history look like entirely? Not just in the last 12 months. I mean, yes, we want a clean 12 months, but what has their credit looked like? What are they looking to do here? And I think that you're not going to get that personal care and that personal underwriting all the time. And so that really sets us apart. We really, really try to do what we can to get these people in their homes.
Awesome. And I know that you had just said, if somebody has a 680 credit score, there may be something there that suggests they move on to denial. But just in general, as someone who is getting into their own home buying journey, what's a good baseline credit score that they should be considering as like a benchmark?
So every lender is going to have a little bit of a different qualification, but I will say standard is you want to be above 640. Anything below that, there's probably some serious delinquencies or over limit spending, things that we're going to be like, okay, they're not financially ready yet to take on this huge debt. But then, it's hard to say, we've seen a 680 credit score that is perfect payment history, has never ever been late on any account. The only reason they're at a 680 is because they have a few credit cards that are at the max or above that 50% limit. And have we denied for that in the past? Only if we see a pattern, maybe, a lot of recently opened new unsecured accounts. They just opened 5 credit cards in the last year. That's like, okay, that's a red flag for us, right? But then you could have somebody that has a 750 credit score, but again, they only have 2 trade lines, and so they don't have enough credit history for us to say, you have a great score and you have a good payment history, but you only have 2 established credit accounts. So it's really hard for me to say 680 is bad, 750 is good.
Sure, no, yeah,
right?
Variables.
Because it's the whole picture.
If someone only has 1 or 2, what did you call them? Credit lines?
Trade lines.
Trade lines. Do you give them advice on where to seek that 3rd or 4th trade line, or is that sort of up for the consumer to decide?
So what we do is we will ask them if they have any alternative credit. So do you pay a monthly membership to your gym? Do you pay a monthly cell phone bill? Can you give us a bank statement that shows those 12 payments being made over the last 12 months? And if they can, and they have 2 good solid trade lines, then we may take that alternative credit and accept that. It's hard to say to someone who only has 2 trade lines, you should go open a credit card, right? We never want to encourage somebody to go open debt.
Yeah.
But what we can say is, we have a great credit builder program. If you have like $500 cash, there's really no risk to either party, and it helps you build your credit, but you really could use a few more trade lines.
What would you say? Sorry, I'm thinking a little bit out of the box here. What would you say is the average amount of trade lines somebody might have that's seeking home ownership for the first time?
I would say like 5 to 6.
Yeah.
Many of them have had autos, a couple, so they've had some that have paid off. So you have closed trade lines, and now you have new ones with the new autos. We don't discount those closed trade lines. They still have a history of, your payment history. And then they typically have a few credit cards. So newer borrowers, first-time home buyers, like 5 or 6. Okay. But I'll tell you, there's, you get people who have been doing this a while, purchasing homes and vehicles and student loans for their kids or whatnot. You could have pages and pages of trade lines.
I'm a little frightened to know what mine actually looks like. I should know, but but hearing you say that somebody might have 5 or 6 credit cards is bonkers to me. That seems like a lot. What do you think the average is there in terms of a number of credit cards someone has, and what's the most that you've seen?
5 or 6 is not a lot.
Really?
Yeah, because think about it, right? So some have like an Amazon credit card, then they have like a Kohl's credit card, then they have like their Discover credit card, right? So they add up quickly. Even if you don't use them, they're still on your credit report, right? And then, the big thing is you don't want to close your credit cards out because you do have all that history of when you used them, and when you close it out, all that history goes away.
Oh, I didn't know that.
And so there's a, fine line between should I close this credit card or not? It shouldn't be out there. I don't know. I would say lower your limit. If you don't use it often, lower it to like $300 or something. So if it gets stolen or, anything like that, there's not a big exposure there. But it's not unusual to see like 5 or 6. And when you say how many have we seen, 12.
Man, that's wild.
Yeah.
That's interesting, though, that when you close a credit card, it's, sort of removed from your history. But you were saying a second ago, there's old auto loans that, have been paid off, but you can still see those. Why is that the case? What's the difference there in the trade line?
Yeah, so the autos, all of them will stay on your report for a certain amount of time. So they can't stay on longer than 7 years. So if you pay off an auto, it will end up falling off of your report within 7 years. Same thing with a credit card, but I think credit cards for some reason tend to fall off quicker than the autos. But they look at when did this person establish credit? So, if you opened your first credit card 20 years ago, you've established credit 20 years ago, right? If you then close that, well, what's your next recent one, that you established credit?
Interesting. Rooted in the sentiment of hindsight being 2020, let's get into Banking Time Machine. Stephanie, our next segment here is called Banking Time Machine. What's something that you know now that you wish you had known when you were younger?
So I think what I wish I had known, I've purchased many homes and I've always hit the market pretty good. And I think it's because I'm in the industry, right? So it's like, oh, now's a good time to sell and buy something new. The market's good. I think what I wish I had known is the benefits or the rental market these days. It's a strong rental market out there. And if maybe I'd kept some of those homes instead of always selling and purchasing, maybe I would have this additional income stream coming in. But who knew the rental market would be what it is, right? Yeah. Rents are almost more expensive than mortgage payments these days.
Yeah.
You can't predict that. But I guess if I had a time machine, that's one thing I would have done differently.
That's a great answer. Thank you. All right, let's circle back to loan process for a minute. What is the process? What can folks expect? What are the steps someone would need to take to obtain their mortgage?
Sure. The most important thing is to be prepared and get your documentation into the bank as quickly as possible, because that will really speed up the process. And when I say documentation, the typical documentation that the lender needs to get your loan going is 1 month's worth of pay stubs, W-2s, bank statements, and generally, I wouldn't give tax returns unless they're asked for. We don't always need them unless you're self-employed, but if you are self-employed, then some tax returns as well. That at least gets the process going. We then order your appraisal, and that takes time. We order the title work to make sure the home that you're buying has a clean title. That takes time. So there's a few things that if we can get those going quickly, it just starts the clock that much quicker. If we can order appraisal and title right at the beginning, that, say, 3 weeks that it takes to get those back will start right then and there. And we can be working on your loan while we're waiting on those if we have your documentation. So just try to work really well with your loan officer when they're requesting documentation, because that will really move the process along quickly.
Excellent. Thank you for that. Stephanie, are there any tools, like an app, that you'd recommend a consumer to have to help them track progress, stay on top of servicing their loan?
Yeah, so we have, here at First Seacoast Bank, we have the First Seacoast Bank app, which you can see your loan, see the payments, the outstanding balance, your rate. You can look at any checking or savings accounts you have with us. But another unique tool that we have out there is called Credit Sense, and that's a free service that you can use to monitor your credit report. And I feel like people should be looking at their credit reports almost like they're looking at their checking accounts, right? So sign up for alerts. If somebody opens a new credit card and you get an alert and you say, hang on, I didn't open a new credit card, you can stop a possible identity theft or fraud right there just by getting that alert and saying, I didn't do that. Or looking at your credit and saying, wait a minute, what's this account? I don't recognize this. So just maybe getting in the habit of looking at your credit like you look at your checking account. And let's get familiar with what credit looks like.
No, that's a good point. I'm curious because, I've heard in the past, like when your credit is being pulled, it's sort of a ding against your credit. Is it a ding against your credit if you're constantly looking at your own credit?
It is not. Nope. Only if a lender pulls your credit to review it. There's two pulls. There's a hard pull and a soft pull. A hard pull is you've applied for something, some kind of new credit, and a lender is pulling your credit. A soft pull is, for example, you're going to get a new cell phone, and the cell phone provider wants to know what your credit looks like, but you're not essentially opening a new credit account. That's a soft pull, and those don't affect your score like a hard pull.
All right. I love learning new things. I appreciate that. Is there anything else that we haven't covered here today that you'd like to share?
I don't think so. I think if anything, if you take away anything from this, is just know the value of your community bank, and being able to reach out to someone easily when you have questions or if you have issues down the line. It can be very, very difficult reaching out to a servicer that has an 800 number and you don't know who you're talking to and you can't get directed to the right person. I just think there's a lot of benefits.
Yeah, oftentimes you're not even talking to a person. You're just stuck in a stream of how do I get a person on the line? Whereas with, First Seacoast Bank, I could just swing in and knock on the desktop. Hey.
Yep. And another thing too that we see, the problem is these lenders will sell your mortgage, right? So they sell it to, let's say, Mr. Cooper, but then Mr. Cooper goes and sells it to, say, United Wholesale or whomever the lenders may be. So then when it comes time for you to sell that house, you want to sell a house now and purchase something new. Now title doesn't, let's say they don't have a discharge to your house, right, that you're looking to purchase, this new house, because it's been sold and sold and sold and sold, and then that servicer went out of business, and now they can't get the discharge. It can create so many more nightmares than people would even think of that we see on titles and things like that.
Thanks for tuning in to this episode of Bank On It, Conversations with First Seacoast Bank. I'd like to thank my guest, Stephanie Morneau, for offering up her thoughts today about demystifying credit. First Seacoast Bank is a member FDIC equal housing lender. For more information, visit www.firstseacoastbank.com.